Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q3 2020. Today's session, we're going to be focusing on key findings in the Experian Moody's Analytics Main Street report for Q3, as I said, and the review is going to be presented in three segments. Presenting from Experian will be Brody Oldham. He's the Senior Director of Analytics Consultancy. Presenting from Moody's will be Christian Doridus, Assistant Chief Economist, and Derek Grunfelder McCrank, Associate Economist. And so now I'd like to hand things over to Christian Doridus to get today's session underway. Christian.
All right, thank you so much, Gary. So a lot has happened since our last webinar, certainly, about a quarter ago, right? We've had the recent vaccine announcements, that's certainly a plus. We've also had, unfortunately, a rise in infections. And on top of that, we've had an election in the meantime. So a lot's been going on, a lot to discuss here. What I'd like to do in the time I have here is present to you the Moody's Analytics outlook for the economy for 2021 and beyond, give you a broad overview. Then I'll identify some of the key assumptions to that outlook. What are some of the things that we have to assume into that forecast? Perhaps you have a different opinion, and that's going to lead you to a different conclusion in terms of either a more pessimistic or optimistic outlook. And then finally, I wanted to focus on just a few key trends or risks specific to small businesses and the small business outlook in particular. All right, so in terms of the broad economic outlook, we can focus on real GDP, so inflation-adjusted gross domestic product, to get a sense of what's going on in the broader economy. Obviously, there are many economic indicators we can look at that give us valuable information. This is just one that gives us a general sense of how the economy is doing. If you look at the measure here, you can clearly see the recession earlier in the year. We lost over $1 trillion worth of output on an annualized basis within that first quarter there. By the second quarter, we were reopening the economy though, and so we did have the bounce back. The third quarter has progressed nicely as well. So we've been making our way back up the hill, if you will, towards our pre-pandemic levels of GDP, but we certainly aren't there yet. Now, if you look at our baseline outlook, that's the gray line in the middle of this slide here. What you can see is that our projection is that the economy will continue to grow and continue to rise, and eventually, perhaps by mid to late 2021, we will have fully recovered our lost output. However, if you stare at that line closely, you can see that the first quarter of 2021 is moving a bit sideways. So we do expect to see some short-term declines in the economy, or at least some short-term friction in the economy before we see the effect of the vaccines kicking in. Widespread distribution of the vaccines, which are being started now, should lead to greater consumer confidence, greater business confidence, and that will lead to some greater spending and investment. One of the green shoots in the economy right now that I would identify, a reason for hope, is that the savings rate among households is still very, very high. It skyrocketed during the pandemic when households received transfer payments and didn't have opportunities to spend, so savings rate rose. That savings rate has come down, but it's still very high, in particular for higher income households. So on the other side of the pandemic here, as we see the COVID cases falling, we should expect to see some of that money coming off of the sidelines and back in the economy, supporting both spending and business investment. So that's the longer term positive view. The other thing to note on the slide here, though, is that there are some other lines, there are some alternative scenarios that we run as well. So we run a simulation of the economy every month, and you can see that there is certainly a wide spread in possible outcomes. Scenario 0 and Scenario 1 identify the 4th and 10th percentile in a distribution of economic outcomes, and certainly they represent a situation where things go better than expected. Perhaps the vaccine will be distributed much more rapidly than we anticipate. Individuals will accept it and take it, and we'll get those COVID cases down, and that will certainly help to boost economic growth, particularly if at the same time Congress does come forward with some additional stimulus, some support to the economy. That should be an extra kick in terms of the acceleration of the economy. On the other hand, you have some downside risks. You can see our Scenario 3 and 4 indicating more of a double dip recession, where the spread of the vaccine may not, or the the delivery of the vaccines may not be terribly effective. Maybe people will resist it, and as long as COVID cases remain high, there will be certainly a drag on economic growth. You can also see gridlock or potential gridlock from Congress leading to a slowdown in growth as well. So you have a wide range of outcomes here. The baseline is certainly on the more positive side, but we certainly should be mindful of the upside and downside risks. And to that end, on the next slide, you can see some of the 4 key assumptions that we embed within this particular forecast. And actually, I would argue any forecast you're looking at now, it's the end of the year, lots of you, there will be many forecasts put out. All of them are going to rely on some key assumptions that are outside the history or the economic data that we can use to forecast. So we have to make some assumptions, first of all, about COVID-19, the trajectory of the infections and the resolution. As I mentioned, that's going to have a very direct impact on confidence. Our working assumption, or our baseline assumption, I should say, is that by February, we should have 25 million Americans inoculated. And by the middle of the year, perhaps by September of next year, we should have a situation where 60–70% of the population is inoculated. That's our working assumption. Again, certainly there's uncertainty around that. Upside and downside risks would take you to those S0 or S4 type of scenarios. And on top of that, we have to make some assumptions about fiscal stimulus. As I mentioned, right now we're in a little bit of a precarious spot. We have rising infections. We have the hope of a vaccine on the horizon. But between now and then, there is certainly some weakness on the balance sheets of a number of households, particularly at the lower end of the income distribution. These are households that depend heavily on jobs and job growth. They're living paycheck to paycheck. And so any type of weakness in job growth, as we've seen recently, does put the continued growth of the economy at risk. Our working assumption here again is that there will be some support given to households to get them through these next few months before the economy can really generate a self-sustaining type of recovery. There is risk though here. You have a number of people who are behind on their rent. Actually, millions of households are behind on their rent. And so there is a threat of evictions dragging down the economy, along with potential delinquencies and defaults. 2 other key assumptions that also factor into the forecast are interest rates and monetary policy. Our view is that interest rates are going to remain relatively low for an extended period of time. That will be supportive to the economy, but at the same time, the other assumption that we have to consider is what will happen to asset prices. Given low interest rates, there's a risk that stock markets get inflated or house prices get inflated, and a pricking of the bubble certainly would lead to some downside risks. I don't see that as an immediate threat at this point, so I won't dwell on it during our brief recap here, but certainly that's something to keep in mind. Now, I mentioned that fiscal stimulus is a key assumption in this forecast, and certainly we have our own views of what the Congress is going to decide in terms of providing additional support in the short term, but I'd love to get your opinions, you in the audience here, so perhaps you have a quick poll question on what the fiscal stimulus outlook looks like. All right, very good. So the question on the table here is, when will we get more fiscal stimulus?
Just get your votes in here. It looks like after January 21 is general consensus here.
Okay. Yeah, I wouldn't dispute that. It is looking increasingly likely that gridlock is taking over. I will say that the last few months have been a bit of a roller coaster when it comes to fiscal stimulus. I think the need for additional stimulus is quite clear to both sides of the aisle. Right? There might be some rhetoric around that in terms of the specific amounts, but both sides do recognize that we do have slowing job growth, and therefore some additional stimulus until that vaccine can be distributed and provide some additional support is necessary. So if that's the case, that is a little bit more pessimistic than what is factored into my baseline. I'm assuming that we would get something past a short-term solution in the next few weeks here, but with a lion's share of stimulus coming after the new Congress is seated. Okay, with that, let's move on to the next slide. Another point to make here is just the geographic distribution or impact of the coronavirus and the recovery itself. You know, we've done a lot of work to understand which parts of the country are more or less impacted by the COVID shock. Certainly that translates very directly into the performance of small businesses. As you look at my map here, you can see I've color-coded metros that rank highly on the index here, meaning these are areas that may have higher infections or demographics that are unfavorable, meaning they're more vulnerable populations, maybe an older population that's out there. Population density certainly matters as well. And then of particular importance is the industrial mix. So areas that have a particularly high exposure to leisure hospitality or the retail industry, for example, would score more poorly on this measure than other areas. And finally, one very important measure is just the income levels across the country. As I alluded to, this is an economic shock that is having a direct differential impact on folks across the income distribution. So those metro areas with a higher share of folks in poverty certainly are at higher risk of COVID-19 economic fallout. As you look at the map here, you can see, I think, some areas that you might expect to have been harder hit by COVID-19. So an area like Orlando or Las Vegas, areas that are very dependent on tourism, have been harder hit. Other areas less so, may be benefiting from lower population density or a better industrial mix, one that is not as dependent. The one last thing to note here before we move on is that although these areas that I've identified in red have been hardest hit, they are also perhaps the areas that will stand to gain the most once a vaccine is distributed and consumer confidence does return. So Las Vegas, for example, very hard hit by the tourism, dearth of tourism that has occurred. As we get more comfortable, we can certainly expect to see more people traveling to Las Vegas. Okay, let's move on to the next slide here. And I wanted to mention just a few trends when it comes to small business and what might we expect for both business failures and the performance of small business loans. The bottom line is we should expect another wave of business closures and layoffs. Small businesses have done an admirable job of hanging on as best they can. They've benefited from some of the financial support of the federal government. The PPP loans and grants certainly have helped a number of businesses weather the storm. But now, certainly, with another wave of the pandemic upon us, it is very likely that a number of businesses are going to be pushed out of business. They just can't hang on any longer. Now, instead of looking at bankruptcy data, which may not fully capture what's going on with small businesses, in particular micro businesses or the smallest of the small businesses, they typically just close their doors. They don't bother to file with bankruptcy given the expense. So in order to get a better picture or a more clearer picture of what's going on with small business, we focus on data from Yelp. Right? That's the consumer rating site of different businesses. And as you can see in the data here, we do see an upward trend in the number of businesses that have been labeled as having been permanently closed. We got some favorable relief during the middle of the year, right, around June, July, as those PPP loans were keeping a number of businesses alive. But as I mentioned, we are seeing that upward trend, and we should expect to see additional business failures over the next couple of quarters as the economy adjusts. In particular, on the next slide, you can see that certain industries are being impacted more than others. I don't think there's any real surprise here. It's the restaurants and retail businesses with a lot of exposure or potential exposure to the public that are most at risk or where you've seen the most failures. Other businesses, particularly those that cater to housing and any type of home repair, certainly have been doing much more favorably. Auto repair as well, given the demand for used cars, those auto repair shops have been quite busy and have performed favorably. Now, one last point to make, I'll end on a little bit of a high note or a more optimistic note, is that despite these closures and business closures that we're seeing, at the same time, on the next slide, we can see that entrepreneurship has actually been rising, right? The number of individuals who are applying to open new businesses is at a record high. So despite the large number of layoffs, over 20 million layoffs that occurred earlier in the year, you did see a number of individuals turning right around and identifying opportunities to start a new business and cater to a new economy. So that certainly gives us hope for the future. New business formations won't necessarily help us in the next quarter or two, right, in this very critical period. But again, once the vaccines are distributed and we're past the pandemic, the horizons are much brighter given these business formations that are going on today. So with that, I'm going to stop. I'll turn the call over to Derek, and certainly look forward to any of your questions.
All right, thank you very much, Chris. So to start off my section, everyone, I always like to thank Experian for providing us at Moody's Analytics with their data. It contributes greatly to our analysis, and I think it's a really valuable data set, not only for us, but for all of you on the call, because there are millions of businesses in this data set, so we are able to get a very accurate view of what's going on in the small business credit landscape, and really drill down into the data and see an accurate picture of what's happening for small business credit. So to jump right in, starting out, just my normal slide, not severe delinquencies, but moderate delinquencies for small business credit. So moderate delinquencies defined as 31 to 90 days past due have dropped quite precipitously in the third quarter on the back of continued balance growth, which you'll see on the next slide for commercial loans. As Chris said, PPP loans, other government assistance, as well as loans from private institutions have really helped small businesses weather the COVID storm that they've been facing this year. And that balance growth combined with forbearance plans and other policies put in place by lenders to help limit the number of small businesses that are facing delinquency, that are facing default on their loans, has really this year helped the balance side of these delinquencies really stay pretty constant. We haven't seen that as much on the severe side. Some businesses are still going into severe delinquency, as I'll show you later. But in this moderate category, delinquencies have been pretty steady this year, while balances have risen incredibly, which is why we see this drop off in Q3. So going down to a 1.2% delinquency rate, which is a series low. So right now things are looking very good on the surface, but beneath the surface, there might not be as good of a picture as is painted by my first slide here. And then just to show you, balances are rising incredibly. On the screen here is C&I loans and leases from data from the FDIC. And as you can see, on a year-over-year basis, these loans are up 20%, which is incredible growth. So balances are really rising just at unprecedented levels right now. Moving on, looking at the Small Business Administration's portfolio, we see charge-offs rising a little bit in Q3. So they're just beginning to come off of the all-time lows that were set in, say, Q1 before small businesses really knew what was coming their way. So Q1 was a series low, and then it's kind of bounced around its floor throughout the year and just ticked up a little bit in Q3. And if we don't see increased fiscal accommodation for these small business loans, we may see the tides beginning to turn in the SBA's portfolio as we move into 2021. So more businesses moving into those later stage delinquencies and eventually charge-offs, as you see here, without that further fiscal accommodation. As I mentioned before, severe delinquencies have been trending down. They ticked up a little bit in Q3, but you don't see that here, again, because balance growth has just been so insane this year, with balances rising 20% from this time last year, that even though in the severely delinquent category, we have seen balances rising. In our data, it's been about a 5% rise in delinquent balances, but that's just been buried underneath all these new balances that have been coming onto lenders' books. And part of that may have to do with, as Chris showed you earlier, the increase in entrepreneurship. So all these new businesses that are being formed, people may be getting loans for them, looking to ramp up or expand their new businesses as they open. So before I move into my last slide, Gary, can you throw up my poll question, please?
Sure thing, Derek. This is the poll, the travel one or consumption?
Consumption.
Okay. There we go.
So during COVID-19, how has your consumption from small businesses changed? Have you reduced the frequency with which you consume from small businesses? Have you increased your consumption from small businesses? Or has your consumption from small businesses stayed roughly the same this year? So if you can all go ahead and select one. So a lot of you said that the frequency with which you consume from small businesses has decreased. I'm actually a little surprised by how many of you said stayed the same. I know there's been the movement for buy local this year, support your small businesses. So I am glad to see that that's a little bit higher. But I did throw this question up here because I was expecting a lot of you to say that your consumption has decreased. With shutdowns from COVID, a lot of what we've seen in demand data from small businesses is that their businesses have been severely impacted. Demand for their products and services has fallen, which is part of the reason that small businesses have had so much trouble this year because of these shutdowns where people just can't get into their locations. And not all small businesses have a web presence or an easy way of distributing their goods or services remotely. So this is the result that I expected. And because of this decrease in consumption from small businesses, one of the effects that we've seen, which is particularly interesting on the macroeconomic side, if I can adjust my slide, here we go. So throughout 2020, we've seen that employment at small businesses, specifically those between 1 and 49 employees, is down by about 2 million people so far this year. And we've seen in the third quarter that rebounded a bit as Chris showed on his first slide that reopenings were happening. We saw small businesses bring some of their employees back, and some of those people who were temporarily furloughed regain employment. But that hasn't happened at the pace that maybe would have been expected as economies were reopening. And as Chris said, if we go into further shutdowns, we may again see these small businesses shedding employees. So this is one of the interesting macroeconomic side effects that we've seen from small businesses as they shut down, that many of their employees were let go, contributing to unemployment rolls. And from a credit perspective, this may also impact why we've seen delinquencies and charge-offs remaining at the low levels that we had seen, say, in 2018 and 2019. So small businesses have adjusted very quickly in order to preserve cash and try and keep their businesses afloat, rather than shutting their doors or potentially declaring bankruptcy. So small businesses are surviving for the moment. Hopefully there will be more fiscal stimulus, hopefully before January 21st, as many of you thought. But if not, hopefully small businesses can survive until then and keep their doors open. And with that, my section is done, and I will turn the presentation over to Brody.
Okay, thank you, Derek.
Thanks, Derek. Thanks, Chris. It's always fun to hear different perspectives on the economy and where we see ourselves sitting globally as far as recovery. And, you know, as we look at businesses here within the U.S., that can really be impacted by how the rest of the world is coping with the pandemic. When we think about COVID and how it's been expanding within the U.S., it's certainly over 150% higher than it was just in the second outbreak session in July. So we're much higher than we were then. We look across the nation and we look at specific regions. You know, it went from at the beginning of the year on the coasts and in large MSAs. About 2 months ago, we had outbreak spread for COVID in the central U.S., in the plains regions. It's back to the coasts, and certainly in our northeast region, we're seeing outbreak spread. I mean, New York sitting at a higher level than it was back in April and May as far as COVID cases and the difficulty that they're having there in that northeast region. So we need to be thoughtful of that and how that will impact both the business owner and the small business itself. So we're going to talk a little bit about both of these cases, look at it from a consumer or a business owner's perspective, and then we're going to move into small businesses. So it's good to hear Derek and Chris talking about some of those pressures that are impacting these small business owners, and I want to touch on a few of those now as we get into really our evaluation of what we'll see in the next few months here. So when we look at overall our state of the market for our business owners and consumers, what you're going to see here are just two indicators that I like to look at. First, we look at bank card, and we're looking at originations here. So this is unsecured debt that our business owners have. And, you know, you think about it, if you're a small or micro business, what are you going to use if you're challenged with cash flow problems? You're probably going to use your credit card, or you might look at an SBA loan to take out for some longer term stability within your business. But what we see here is on the consumer side, a business owner using their consumer facility. And what you'll see is that bank card originations have picked up in the past few weeks. And that's interesting to see because it has ebbed and flowed here a bit as PPP ran out toward the end of August. We saw a pickup in bank card usage and utilization. As we're getting into a time where that money has run its course, we have a feeling within small business that there's some stability coming back. We've seen a decrease in the origination of these new facilities. But what that also means is that, and what we'll talk to in a little bit, is that creditors have tightened up their criteria of debt. So originations are down for these types of products. Now, as we come out of paycheck protection and some of the direct stimulus that's been given to consumers, what we're seeing now is that some of that money is running out. And like Chris talked to, there's a differentiation between those that, a separation between those that are on the higher end versus the lower end of the spectrum as far as financial stability. We do see recovery just different as far as economic recovery. Very different between the two sets. What you'll see here as we come out of PPP is that delinquency is beginning to rise. You'll see some statistics here on the right hand of the slide that look at credit line increase and decrease statistics. What you'll see is that there has been a big rise in credit line decreases over the past few weeks as they picked up a bit. I think we're seeing the end of that stability as COVID spread continued to rise. We're seeing that end of the feeling of stability. And so some of these recession-proofing activities are kicking back in for some of our creditors as we go forward. And we really want to keep those lines of credit open as we go forward. So that's why we talk about a few of these. You'll see some of them ebb and flow just a little bit as we get into December. Now, what I also want to touch on here, we'll go back up one, is to look at forbearance activity. So when we look on the consumer side, you know, through April and May, we saw a lot of forbearance payment holidays that were out there. And this view is an overall view on the left-hand side of the screen. And really what you're looking at are opportunities for consumers to push off payments to a later time frame, to have some type of loan modification or payment plan put in place. What's happening, though, is that as we look at bank cards, these have really tapered off. When we look at mortgage accommodations and foreclosure accommodations, those are tapering off. So as we get into December and January, those programs and moratoriums will begin to end. As Christian mentioned a little bit earlier, on rental payments being pushed to this time, that doesn't mean that those payments are forgiven. it means that those balances have been transitioned to this time where repayments will have to begin again. Rental payments may be double what they were going into the pandemic, and so it's going to create some additional pressure on consumers coming out. Now, what also is going to hit us that we are very close to touching on is foreclosures and activity that's out there right now. So we're about 80% down from where we were last year, and that's because there are foreclosure moratoriums that are inactive for consumers at this time. Now, those are about to come to an end. I know we've been having discussions in Congress to see if we can extend some of those moratoriums out into March and April of this year, but at this point, a lot of those are closing out in December and January. That means foreclosures have been down for a while and have been building, and so those filings are picking up. That again means that we're going to see some volatility in the mortgage market as we go forward, with foreclosures entering some of the real estate valuations out there. As we see some of the volume enter back in to the market there as well, we may see some pressure on home prices, which has been really a buoy to our economy as we've come forward so far in this year. But we may see some pressure on that going into the next few months. What I'll also show you here too is as we went through the PPP program, we had consumers really lifted up during this time on payment holidays for credit cards. Here's just an example on the right-hand side of the screen. What you'll see are the purple, those that didn't make a payment during their forbearance or payment holiday. That means if you had a card and your credit card company said, hey, you don't have to pay, if you still made payments on the credit card even though you didn't have to, if you look in that first bucket on the left-hand side on the right chart, the purple, it means that 72% of those that made a payment are still in that current status. That's really good. But what this means from a flip side of that is that if you didn't make a payment during your forbearance period or your payment holiday, that means that you are much more likely and have a higher propensity to go bad in the subsequent months when that debt is reassumed. And so as we look at this, same thing with the PPP program that we saw with on the commercial side. And you remember as we talked to you the last time we came together, those that are coming out of the PPP program that had that stimulus up until about August when the money began to run out, the velocity of delinquencies was significantly greater than those that didn't take out a PPP loan at all. So a big difference in the performance of those small businesses. We're seeing that same type of performance engagement here on the consumer or guarantor side. So, you know, as we're coming into this next few months, really the story here is that we've maintained and kept some stability in the market from a consumer perspective. But the expectation is that we're going to see a little more volatility as some of those forbearance, payment holidays, some of the push off of utility payments really come to bear at the end of this calendar year, and will come back onto the balance sheets of consumers and business owners as we go forward into the next few months. So a little more strain on cash flow as we go forward, and savings, as Chris mentioned as well. So when we get into the commercial data itself, we're going to look at small business credit share data. This is our consortium data set that brings in millions of businesses. It looks at payments across life cycles and really gets into the different types of industries and how they're performing. And we'll talk a little bit about that today and how different industries are behaving during this time. But we're getting it from our small business share data. We're going to start with origination type statistics, and we're going to start with installments. What you can see here are PPP loans really elevated the number of originations within the installment product. You see that brought delinquencies down because that extra cash flow that businesses had, they actually, in some cases, used it to pay down balances on their accounts. So it kept them, you know, ahead and out of the 30 or 60 day, those early stage delinquency buckets for a little bit. So you'll see those delinquencies go down a bit. We saw that taper off after the program really serviced most of the businesses that were looking for these types of support. And you also saw that in the normal products that lenders were offering, they had turned on again their pre-recession strategies, so criteria was a little bit tighter coming out of April and May. And throughout the summer, it's been that way. They're starting to loosen up some of that criteria to allow more to flow through as they saw some stability and the potential of having Congress come out with another stimulus package in December, the month we're in now. But that, again, I agree with a lot of you that it'll be pushed out to probably the 20th of January as we go forward. And you can see here, we look for that additional stimulus to hit in late January or February. Now, when we look at origination risk, and this really helps us to take a look at where lenders are putting their appetite for risk. And you can see year over year, and we look back a year ago to this year in September, we can see that they've loosened up a little bit. Now you can see them tightening in that really in the summertime in June and July. But as we went forward, they've loosened up a bit and even continued to loosen into September, October, and November. But they're starting to tighten back up a little bit here in December as we see the COVID cases rising. And we know that some of that debt load is going to come back on small business owners as well as small businesses. Because remember, moratoriums on utilities also that have been around the country in different regions, they've done a little bit differently. But some of those moratoriums are, again, coming to a close in December. And so those utility payments that are in arrears are going to come back on the books of some of these small businesses. Now, when we look at different industries, again, we're looking year over year from 2019 to 2020. We can see that different industries are impacted across this installment product. You can see some of those that I've circled a few of these here that have gotten a little bit more risky as far as their portfolio and balances that are for each of the industry. And of course, manufacturing took a hit, but they're able to pull a little bit more of that out now as businesses are trying to get their supply chain started back up again. We certainly saw that in the steel supply chain over the past month or so, where we've seen those that production ramp back up as some companies are buying a little bit more than they need just to prepare if this pandemic continues to push forward, that they can build up a little bit more inventory as they go into some of the tough times. And as they saw prices rise on some of those commodities, they were trying to pull it back in and see if they could get it at a little bit different price point at this time. Now, retail trade, we see that again. You know, one of the things that we keep mentioning is that you know, we're seeing some tough times for small businesses, and that's certainly occurring. We're seeing some uplift in digitization. Small businesses are having a difficult period here where they're not getting foot traffic. But what I will say is that those that are able to create a website presence and provide some type of at the curb type of a service are surviving and have more resiliency in the market. And so some indicators that can be included in data that you use are looking for open and close indicators, temporarily closed. If this business has a web presence, do they have a delivery service? Those type of elements that can be provided to you really help you to differentiate between businesses. And you can see here that as we look at it, it allows, even though some of those balances are getting a little bit more risky, they're not as risky as they could be. And that certainly is helped by some of the pre-recession strategies that lenders have put in place. Now, when we look at delinquency levels across the U.S., you know, as we showed at the very beginning, those delinquency levels have gone down over the past couple months, and that's certainly true. When we look at it from a regional perspective, what we see is that the Northeast, that COVID spread has really started to pick up. And when that happens, you'll see those delinquency levels start to tick up as well. Small businesses have to close. There isn't stimulus there to lift them up and continue the payments. And so delinquencies will start to rise. One of the good things on the right-hand side of the screen that you'll notice is that gap between our 90 days past due and our 60 days past due is getting tighter and tighter. That means that less are straight rolling into the higher delinquency levels. So they're slowly going to the next level up. And so those roll rates are a little slower than they were even at the beginning of the year. So that's really good to see. But the expectation is as we get into a little bumpier time here, we'll see those begin to diverge again, and that'll be a little bit more serious as we get into the first part of next year. Now, when we look at unsecured debt, this is one you can definitely see it in April and May, where those recession policies kicked in for commercial cards, and the lenders out there really pulled back on what they were lending. You can see those 90-day past due balances really pick up and be significantly higher than they were in prior years. We saw that come back down as some stability entered the market. Stimulus came. It allowed businesses to pay down some of that debt and continue to operate. And you know, that was a good thing. That stimulus really helped. Now, as we get into the first part of the year, the hope is that we'll have another stimulus here. Our lenders will be able to open up their underwriting policies a little bit more and continue to lend as they see some of that stability entering the market there and businesses' ability to repay debts as we go forward. So we see that will help originations continue to grow as we get into the first part of next year, but we'll also see delinquencies rising as well for some of those companies that are still struggling, where we'll probably have some potential lockdowns coming up pretty soon and shelter in places in areas where the spread is just escalating at a very fast pace. So as we get into commercial card, what you'll see here is that when we look at origination risk, again, they've opened up and allowed some of these more risky originations to occur. That's bringing in additional data. Remember, a lot of these lenders and are using additional data elements outside of just the core credit data. So overlaying this type of information that allows you to see if a company has a website or has some additional ability to deliver to clients outside of just the storefront and foot traffic. It's allowed some of that opportunity to be grown for additional originations to come in. And so originations have dug a little bit deeper into some of the segments. Some of the advanced methodologies that we use allow us to segment a little bit deeper. A lot of the depression in some of these wristbands can also be because of slow payment. So going into 60 days past due, but then having the ability to repay and cure. So that can bring down some of these origination tiers and make it look like it's a little bit more risky. Now, when we look across the commercial card set and we look at it by industry, you can certainly see some standouts here in mining. On the left-hand side of the screen, retail trade, a little more risky in portfolios that we see. And of course, that is due to some of the pressures that we see on small businesses and the lending that's happening there, and those that are still on book that have the potential to close. Like as Derek said, close their doors without filing for bankruptcy or doing any type of activity in that aspect. Now, when we look at delinquency levels for these unsecured products, again, we see that curbing of the delinquency rates where we see them going down a bit. We're going to see them pick up a little bit more here in the fourth quarter, and we're already seeing that as that stability erodes, investor confidence kind of comes out of the market. We're going to see that those delinquency rates continue to rise. And the Northeast, I think, is going to lead us as we go into the next few months. Again, you see that gap between our early stage delinquencies and more of that derogatory delinquency, closing the gap there, which is good, but we'll see some of that separation as we continue in the fourth quarter. Now, I did want to mention here with fintech lending, so we have that alternative lending, and you can see really in March and April, we had a big shutdown in alternative lenders. A lot of those alternative commercial lenders have been purchased and done some M&A activity to bring those into other businesses, even large banks picking up some of these fintech lenders as we go forward. So we see some of that as a reduction in the lending opportunity within the space for this type of commercial product. During the summer, fintech lenders came back online. They adjusted their underwriting criteria. They're getting back out there. But really, as we've gone into the last few months and into the fourth quarter, it's slowed again. Just because of the uncertainty of the market and some investor confidence has really eroded from some of these sets. But I think bringing in additional data, what I've seen with some of our fintech lenders is that they're bringing in some of this non-traditional data to bolster up some of their process and be able to lend a little bit deeper. and it's getting them back into the space and allowing them to open back up, even in some of the riskier times, identifying targets that are within their risk tolerance set. So we should see this pick back up again in the next few months, even though we'll be a little slower overall as far as originations. Now, some of the things to be aware of as we go forward. I think we're going to continue to see COVID, the spread, impact us through 2021. As we get toward the mid-months, we should see it slow down. Some of the heat from summer should help us to relax a little bit as far as the spread, and so it should have an opportunity to have some more containment activities happen through the summer. So that'll be good. Like Christian said, we'll be coming into a time of recovery toward the end of 2021, and hopefully we'll be back up into those higher scenario levels. We may see return to full recovery more in early stages of 2022, but I'm hopeful. I'll side with Christian on the good scenario, with Chris on some of the good scenarios there. So certainly looking forward to that as we go forward. Now, when we look at commercial lending, we're going to see it continue to be slow. A lot of the debt and utilization loads that are going to come back on the balance sheets of small businesses, as well as their owner, are going to create some harder times or challenges for the underwriting process. As we look at utilization, if you look at utilization on your portfolios and you're originating, you get up above that 35%, 40% utilization. It creates some additional need for review or opportunities to bring in other types of financials to review that particular account, make sure that that business is still fits within your credit criteria. So we're going to see some changes there as far as outstanding debt, really put some pressure on our small businesses as they're working to recover as we go forward. So we're really hoping that stimulus comes. It will certainly help small businesses to cover some of these debts as they come due again in the first part of 2021. So we certainly look for that to be a very helpful tool as we go forward. Now, we will see some increased collection activity and treatment strategies coming into play as we enter into the first quarter of next year. Now, there will still be some moratoriums out there. There are trade creditors, if you look at supplying products for distribution for different parts houses as we go forward for different industries, you'll see that what we've seen is in these trade credit types of partners that we have is that a lot more of their portfolio, a lot more of those outstanding balances are moving into the arrears set. A lot of those businesses don't like to put their clients in any type of collection action or cut them off. They're really looking for anybody to bring in to the fold to sell their products to, and so they allow some of that credit to be extended a little bit longer than normal. What we're seeing now with some of these trade creditors is that they are doing something that, in the past couple of years has been a little taboo, is actually charging a bit of interest on these balances that are in arrears. So still allowing the product to go out the door, but charging a little interest as the balances become beyond the term that was agreed to. So as we go forward. So we're going to see some more of that type of activity to try to keep the economy going and to try to, in some cases, buy their way out of a little bit of the debt that's in arrears as we look for stability in the next 6 months or so, certainly coming out of the spread and looking for an additional stimulus package as we go forward. One other thing that I encourage you to look at is commercial real estate, another indicator that will be out there. As some of us are looking at getting back to work and flying again, not all of us are going back into the office. And so as we look at, in your businesses, you probably haven't been back in and badged into your office in a while. When we look at some of our industry partners out there, one of them like Castle Industries that looks at the number of badges into offices, and they look at foot traffic going into types of businesses like yours and mine. It's down about 80% compared to right before the pandemic hit us in January, February. So, when we look at space, a lot of businesses are looking to downsize the space that's needed. We're not traveling as much. There isn't that opportunity to come into the office. So we are seeing vacancy rates pick up. we're seeing some of that come back into the market, some of those spaces that are larger and that businesses are trying to get out of come back into the market. You're seeing more Chapter 11 bankruptcies that are really looking to restructure. Those are the only ones that are really up for this year. It hasn't really been bankruptcies to close business, but bankruptcies to restructure. And a lot of that is to get out of commercial leases and look for more flexibility in office space as we go forward, because more of us will probably be working from home as we go forward. So I think there will be some challenges in that space as well as we go forward into this next year. And we look at how we're going to change the way we really interact with each other and the way that we react with each other and communicate in a business setting. It'll be different. And I think COVID is in a post-COVID scenario. I think there will be changes in the way that we look at business, and I think that will impact commercial real estate as well as how we see that impact going forward into the next year. So some of the silver linings that we look for with stimulus, we should see it pick up a bit, and we should see that stability return as we get into the new year. Certainly vaccines being distributed as we go forward. We've seen some good advancements across the globe, and hopefully containment by mid next year as we go forward. So I think those are all very positive points and keeps us in that 0 or 1 scenario that Chris showed us a little bit earlier, and keep us on that upward trend. Hopefully our check mark economy doesn't stretch out too much further, but we certainly look for some good advancement and recovery in the next year. All right, Gary, well, why don't we open it up? I know we have a couple more minutes. Why don't we open it up for a few questions?
I unmuted my microphone, but not the GoToWebinar platform. Sorry about that. So the first question that came through for me was, does the C&I balance growth include PPP loans? So Gary, can we jump back to that slide quick with C&I balance growth? So to answer the question while Gary is toggling, yes, the C&I balance growth does include PPP loans with a caveat. So the way that PPP loans were distributed, there was a category assigned at the time the loan was originated. And although the vast majority of PPP loans do fall under the FDIC's C&I definition, a slim portion of them don't. So the FDIC hasn't given out exact percentages that I'm aware of, but they have said that the vast majority of PPP lending is captured within the C&I series. So yes, it does include the vast majority of PPP loans. So those government fiscal programs have really been responsible for a lot of the massive growth that we've seen in commercial lending this year. So those programs have really stepped up to keep delinquencies low and keep credit flowing to small and large firms, but for my interests, small businesses.
Excellent.
So then, and Gary, did you want me to answer the other question for me right away, or should we take someone else's?
Yeah, sure.
Okay. So the other question that came in for my section was new businesses. Do you know what type of new businesses? So in response to when I was discussing one of Chris's slides about entrepreneurship and the new businesses that were helping to propel some of the balanced growth. And the answer to that is we have a general sense. So we have industry categories within the data where we can see that a lot of the growth or entrepreneurship, new business formations that we're seeing in the small business credit sphere are from financial services businesses and services businesses. So we have a general sense, but the services category is very broad and can capture quite a few things. Just going off of what we know about small businesses and COVID this year, I'm guessing that although restaurants fall in the services category, not a lot of the new businesses are restaurants. It's probably more on the professional, scientific, and technical services side of things. But without drilling down into the NAICS codes assigned to each loan or business in the data set, that's as specific as I can get right now.
And Derek, I'll add to that a little bit too. I think it's good at where you're going with this is certainly that expansion is in sole props. We've seen a lot of that individual small business, micro business be really a big portion of these new openings. You know, people are out of work and have an opportunity to develop their own business and really get it started up. We saw a lot more growth in retail, online type of new businesses. So that's been a real boost as we go forward. That digitalization of the retail space and being able to sell things online is really where we've seen some value. When we really get into the holiday season, one of the things that we're seeing is that people haven't been traveling as much. They got a little more money in their pocket. They haven't had to, go outside and spend money on fuel as much as they had in the past. They have a little more cash to spend on some of the holidays that are coming up, and so they're out shopping. So we've seen retail sales pretty good coming into the end of the year, and that's certainly going to help some of these small businesses. If we have cash in our pockets that we can spend, go to our small businesses, go to our retailers, that's certainly going to help us close out 2020 better than expected, and certainly give that retailer a good V-shaped economic outlook as we go forward. Chris, anything to add to that?
I guess very quickly, I know we're at the top of the hour here, but just on this question, I think the Yelp data actually provides some interesting insights, right? So the Yelp data is publicly available, so I encourage everyone who might have an interest in it, want to look at longer term trends, to take a look there. But what is fascinating is that although you have lots of businesses obviously that are closing, you do have others that are opening, and they're opening actually in areas across the board. So even in restaurants or food services, it might be the sit-down dine-in restaurant that's closing, but then at the same time you see an uptick in food trucks or in food delivery services. So I think you do have entrepreneurs looking across the board and seeing opportunities, and they are identifying those. And it does make me optimistic that this is not just a niche type of entrepreneurship that's going on, but it's something that is a bit more broad-based. And so hopefully this trend takes over and propels us forward.
Okay, we're going to have to leave it there, folks. We ran out of time. We will be reaching out to those who asked us questions and getting responses back to you. There were plenty in there for us to be responding to. I want to thank Chris and Derek from Moody's Analytics for coming on today and sharing that great insight with us and the analysis on the Main Street report, which we collaborate on together. Looking forward to the next one, which will wrap up Q4. If you need to find further information on Moody's, of course, you can find that at moodysanalytics.com. And then for Experian, it's experian.com/B2B. Everybody have a safe and happy holiday season. Please take care of yourselves until the next time. Thanks very much for coming today.